Welcome to the Masterclass. Today, we're looking at a corporate landscape where simply reacting to a crisis isn't enough. Ajke environment, managing a business requires a state of continuous, technology-driven evolution. To understand why, we have to start with the maturity wall. This is the volume of corporate debt, much of it taken on during years of lower rates, that is now coming due simultaneously. Because financing costs remain elevated across the G7, refinancing this speculative-grade debt is becoming prohibitively expensive. We are entering a window between 2026 and 2028 where this pressure will peak. This means businesses can no longer rely on simple debt extensions to survive. To address the cost of capital, they are being forced to restructure their core operations and asset portfolios. High financing costs and the looming debt peak mean that survival now depends on how a company operates day to day. While financial engineering can delay the end, it cannot provide the resilience needed to navigate this specific capital environment. At the same time, the global trade landscape is fracturing. The integrated financial order we've known for decades is splitting into regional, politically aligned blocks. This chart tracks the rising cost of moving goods. The average applied tariff on global manufacturing climbed from 1.9. The cost of abandoning these complex legal entities is high, making it harder to find the cash needed for a successful restructuring. This brings us to the third pillar of the 2026 economy, the massive growth in capital expenditure for artificial intelligence. To give you the sense of scale, the current AI infrastructure cycle is comparable to the telecommunications build-out of the late 1990s. The multi-trillion-dollar investment required for these data centers is creating fierce competition for capital in the short term. As liquidity flows towards AI, it crowds out traditional industrial and infrastructure projects, pushing their borrowing costs even higher. There is a risk here. If these massive investments don't show a clear return quickly, we could see a correction that hits both the tech sector and the traditional industries that have been starved of capital. Module 2A, Capital Flows. You'll often hear this question, with interest rates at these levels, where is the liquidity actually coming from? In Q1 2026, investors poured $300 billion into startups globally, equating to 70% of the venture capital deployed in the entire previous year. Crucially, 80% of that total, $242 billion, was raised exclusively by AI companies. Global liquidity is essentially abandoning a diverse range of startups to fund the artificial intelligence arms race. That 80% allocation is highly concentrated. 65% of all global venture capital in the quarter went to just 4 companies. Those rounds include OpenAI at $122 billion, Anthropic at $30 billion, and xAI at $20 billion. Rounding out the 4 is Waymo, which secured $16 billion for its autonomous driving platform. This activity is driving premiums down the entire pipeline. AIC rounds now carry a 42% premium over non-AI peers, a trend seen in the early success of companies like Francis Mistral AI. At later stages, Series A mediums are now crossing the $50 million mark, while Series B medians have reached $143 million. Investors aren't pricing these companies on current revenue. They are paying for a credible path to market leadership, where the winner likely takes the entire market. All this private capital will eventually need a public exit, and that is creating a massive upcoming IPO pipeline. The targets are enormous. SpaceX aims for $1.75 trillion. OpenAI targets $1 trillion, while Databricks and Cerebras are both preparing to list. Combined, these companies represent over $2.9 trillion in float that the public markets will have to absorb. This $2.9 trillion requirement will act as a liquidity drain. For non-AI companies, successfully launching an IPO in 2026 will be an uphill battle. We move now to Module 2B, Advanced M&A. While the tech sector booms, the industrial M&A market is also surging. Total deal value reached $438 billion in Q1, up 155%. Because Elon Musk is the controlling shareholder on both sides of the merger, standard board protections are under scrutiny. Under Delaware law, this triggers the entire fairness rule. This rule shifts the burden of proof to the board and the controller. They must demonstrate that both the process and the price were fair, which creates significant liability for directors and officers. Notably, the deal proceeded without independent fairness opinions from investment banks, relying instead on internal valuations of $1 trillion for SpaceX and $250 billion. By merging while both companies were private, the controller could negotiate terms without the disclosure requirements of a public merger. The scrutiny will likely come during the IPO roadshow later this year. Now let's look at the consumer space, specifically the $44.8 billion combination of Unilever Foods and McCormick. The valuation for the Unilever Foods unit was $44.8 billion, representing 13.8 times its 2025 EBITDA. This shows a reverse Morris trust. A parent spins off a subsidiary, which immediately merges with a partner. The deal gave Unilever shareholders 65% of the combined equity, worth $29.1 billion, along with $15.7 billion in cash. McCormick keeps its headquarters in Maryland, but will establish an international base in the Netherlands to integrate with Unilever's existing food R&D. The reverse Morris trust is a powerful tax tool. By ensuring the parent shareholders hold at least 65% of the new entity, the entire $44.8 billion transfer avoids U.S. federal income tax, protecting significant value for the shareholders. We move to Module 2C, Distress and Restructuring. For companies that can't find a merger partner, liability management exercises, or LMEs, have become the primary alternative to bankruptcy. These exercises are possible because of a shift in how corporate debt is written, specifically the move toward Cov-Lite credit agreements. Cov-Lite loans went from just 1% of the total leveraged loan market in the year 2000 to over 90% by the year 2021. These agreements removed continuous quarterly tests. They replaced them with incurrence covenants that are only checked when a company takes a specific action, giving borrowers much more freedom to move assets. This flexibility created document gaps, like flexible investment baskets, that distressed borrowers are now using to navigate the maturity wall. This freedom has led to creditor-on-creditor violence. Because institutional holders like CLOs now hold 65% of all loans, the creditor base is often too fragmented to coordinate, allowing companies to play one group against another. In an up-tier transaction, a company gets a majority of lenders to agree to move their debt to a higher priority, effectively pushing non-participating lenders to the back of the line for repayment. There is also the double dip. A subsidiary takes a loan with a parent guarantee, then lends that cash back to the parent. This gives the lender two separate ways to claim repayment for one loan. This has created a wave of litigation. The Serta-Simmons case saw an up-tier invalidated by the court, while on the very same day, a different court upheld a nearly identical move in the Ocean Trails case. However, the data shows these moves rarely provide a permanent fix. Only 14% of companies executing an LME successfully avoid a later bankruptcy filing. These transactions often act as expensive delay tactics. They trigger intercreditor warfare that buys time, but often at the expense of their excluded lenders. When private deals fail, companies turn to the courts. While U.S. Chapter 11 was once the global standard, it now faces competition from European frameworks that offer more flexibility. This table highlights the shift. The UK's Part 26A plan doesn't require a numerosity test. It only requires approval by 75% of the debt's value, making it easier to pass. This allows companies to target specific classes of secured lenders to force a deal through without involving trade creditors or making broad public disclosures. One obstacle is the rule in Gibbs, which says a debt under English law can only be discharged by an English court. To get around this, some U.S. companies are moving their center of main interests to the UK. They are using the UK's Part 26A as a legal safety net for their liability management deals. For our students in India, the proposed 2025-2026 amendment to the Insolvency and Bankruptcy Code is a major development. It introduces the Creditor-Initiated Insolvency Resolution Process, or CIRP. This is a hybrid model. It allows creditors to start a restructuring out of court, while the debtor stays in possession of the business under the eye of a resolution professional. This brings the IBC closer to the U.S. debtor-in-possession model, although formal court proceedings in India still follow a creditor-in-control philosophy. These second-generation reforms are designed to speed up the process, making India's code a reference model for other emerging economies. In Act 3, we look at non-financial drivers. ESG has become a hard financial turnaround tool. Its impact on corporate debt is now quantifiable. Companies with high ESG ratings see lower financing costs, often saving over 100 basis points on their debt compared to lower-rated firms. This is forcing a reset in industries like manufacturing, where sustainability data is being used to justify long-term value. Data centers are a prime example. To maintain their local operations, they are being forced to move toward water-positive models, which requires significant operational investment. Without a clear return on these sustainability projects, companies won't be able to secure the long-term capital they need to survive the maturity wall. This brings us to labor. The rise of agentic AI is changing how companies are structured, leading to very different labor reforms in different parts of the world. Multinational firms can no longer maintain a uniform global workforce strategy. Hierarchies are changing, and regional laws are pulling in opposite directions. The UK's Employment Rights Act and India's new labor codes have both increased the cost of compliance and strengthened worker protections. Meanwhile, the EU has introduced strict rules on pay transparency and the use of AI in hiring and firing decisions. Restructuring a global team in 2026 means navigating these conflicting laws, forcing companies to gather deep legal evidence before making any major changes. Finally, look at the capital itself. Traditional banks have moved away from risky loans, and private credit funds have filled that gap. Total assets in private credit are expected to reach $5 trillion by 2029. Whether it's a $44 billion spinoff or a debt up-tier, the data suggests that financial engineering alone isn't enough to fix an outdated business model. The firms finding success in 2026 are those using restructuring to realign their assets with current trade and technological constraints. For future advisors, survival depends on moving away from periodic crisis management toward a model of continuous, data-driven reconfiguration.